Hello to all our viewers watching us on Moneycontrol. Always good to see all of you. I'm Ridhima Bhatnagar. Well, today we want to talk about something specific. We want to talk about banking and banking stocks. Now, amid the scare of second wave of COVID-19, which bank stocks should investors really bet on? FY22, should it be a wait-and-watch policy for banking stocks? Now, the $2.8 trillion Indian economy slipped into its first recorded recession amid the COVID-19 pandemic and presents a litmus test for the banks. The test is far from over. The systemic risk facing banks still remains extremely high in the wake of the second wave of COVID-19 infections. The gross NPA ratio of the country's banking system could rise to 13.5% by September 21 from 7.5% that we saw in September 2020. Now, if the macroeconomic environment really worsens into a severe stress scenario, the ratio could surge to 14.8%. There were various measures in FY21 that cushioned banks against an increase in stressed assets. The 6 months moratorium on loan repayments, Supreme Court's order barring banks from declaring any asset as non-performing, and a one-time loan restructuring window did help in containing rise in toxic assets. But despite downside risks, vaccination drive is likely to limit the economic disruption. Now, the economy, which is, of course, already in a recovery mode, will push further the credit growth, and that's why we're still hedging up bets on banking stocks. Let's talk about as far as the economic revival is concerned. The banking system's outstanding credit base stood at rupees 109.5 trillion, growing by 5.6% year-on-year at the end of March 21. While growth in FY21 was subdued, it is expected to pick up a lead by continued uptake in economic recovery, especially within a retail segment. Now, the corporate credit cycle too should pick up pace gradually on the back of a benign interest rate and various government initiatives. If you talk about the financial health of the banks, now as per S&P ratings, the credit losses for India banks is set to decline to 2.2% of total loans for FY22 and 1.8% for FY23, after staying elevated at an average of 2.8% for FY16 to 21. Now, the volume of restructured loans so far has been limited and has been less than 1% for large private banks. The banks created huge provisions for COVID but have not really used them, owing to both lower stress and even increased conservative provisioning policies. Consequently, large private banks have now about 0.7 to anywhere 2% of loans as additional contingent provisions. Now, despite the Supreme Court's stay on recognition of NPAs, most banks have not only disclosed pro forma NPAs but have also made provisions for defaulting accounts in the December quarter. Now, FY21 also saw large capital raising by banks, especially large private banks. ICICI Bank, Axis, Kotak Mahindra, IDFC, First Bank and even Yes Bank. Capital raising has further strengthened balance sheets of private banks, but for PSBs, barring State Bank of India and a few others, most of the PSBs are dependent on the government to raise capital. So, which banking stocks then should investors really be betting on, or which should be on their radar? Balance sheets of three large private players. Let's talk about them. ICICI Bank, HDFC and Axis Bank. It is the best ever in terms of capital, provisions as well as liquidity. Now, through the economic uncertainty will lead to higher volatility for banking stocks, long-term investors should accumulate ICICI and HDFC Bank. HDFC Bank will continue to gain market share at an accelerated pace, churn profitable growth over the next few years and compound the book value consistently based on its strategy of a spike in corporate wholesale loan growth while reducing retail lending. At the current market price, rupees 1,400, HDFC Bank is trading about 3.1 times its core book value estimated for FY23, assuming conservative earnings growth of about 15% CAGR for FY21-23. Given that bank posted high return of assets just above 2%, valuation looks reasonable. At the current price of rupees 560, if we talk about ICICI, that is trading at about 1.6 times FY23 estimated core book value, which is reasonable considering the return on equity or the ROE has inched up to about 15%. Moreover, banks' valuable subsidiaries will also add to the stock's performance. So, in terms of relative valuations too, ICICI is trading at a significant discount to its closest lending peers, offering room for a substantial re-rating. ICICI's gross non-performing assets or GNPAs has fallen from a peak of 8.8% in FY18 to 5.42% on pro forma basis as at end of December. The provision coverage ratio or PCR as we say at 77.6% is among the highest in the industry. The bank also then has adequate capital consequent to the equity raising in the current fiscal. ICICI Bank's balance sheet strength is apparent in its improved funding profile with current and savings account constituting about 42% of the total deposits, de-risked asset book with retail lending comprising of 66% of the loan book. But one must also take into account the downside risk of localized lockdowns and the lack of migrant laborers impacting the sections of the economy. That's all that we had for today. Thanks for watching.